Hello everyone, and the world may seem very big at times and us very small, but it is a beautiful day in Sydney for everyone on lockdown, so at least there's a bit of sunshine around on that basis. In the US overnight we saw one of the smallest gains in price action on what was quite a huge fundamental event, which was the infrastructure bill passing in the Senate, and much to all the anticipation that had led up to it, we did see materials and the industrials rise by about 2%, but still it's a very muted response. And the reason is it's not like previous stimulus measures in that it's going to have an immediate impact on the economy at all. We all know that the US and the whole world is rolling over from the post-COVID pandemic stimulus surge, so that's well behind us now. In Australia today we saw a fabulous result from Commonwealth Bank, but of course that result too was all about that pre-COVID, post-COVID surge of the first wave. Now, as many of us know, the Spanish flu had its second wave, which was far more tragic in its impact, and perhaps that's what Delta surge is, and perhaps the Lambda surge coming out of Peru as well, variants. So we are in for a period of further supply chain disruption around the world, though the world does seem to be adjusting to the idea that we will be having high hospitalizations and even deaths, but we will go on with life. You can debate that from sunrise to sunset and beyond, but the fact is that Australia and New Zealand are in a different situation where they've had that opportunity to suppress things a little bit. And that's still the policy in those countries. So we'll see how the Sydney situation goes, but with 344 cases today again, it doesn't look that great in the short term. In the long term, there will be a solution because there has to be a solution. Obviously, after the second wave of the Spanish flu, things went back to relative normal, and that could be well be the case regarding COVID-19 as well. Though for all we know, it might only be a year away, but it might be 3-5 years away before you could say things are back to normal. But the whole time, the situation should be improving. The problem for the stock market pricing is it's priced in an ongoing nirvana outcome for the US economy and the world economy, if you like, opening up and just having an ongoing economic boom that could never, of course, happen because all of those strong growth figures and recovery figures relate to the economy getting back to about where it was before COVID. US doing a little bit better, Australia a lot better, of course, and there are reasons for that. And Australia, of course, on a per capita basis, had way more stimulus than I think probably any other country in the world. Hence, we've moved up in some economic criteria to above pre-COVID levels. But that is a unique experience. What I'm trying to suggest here is that at some point, the gravity of the reality on the ground of a relatively good global economic progress is distinct from the tremendous pricing that has already occurred in terms of stocks. But where does that end? Obviously, for some time now, markets have just kept heading higher. But I come back to the infrastructure bill overnight. 6 months ago, on that news of that infrastructure bill, even talk about it, particularly 3 months ago, the market was having big reactions to it. But when it actually gets through the Senate, a very muted reaction to 2.3% for a lot of those material stocks like Caterpillar that will benefit from a big infrastructure spend. And as I said earlier, it's not going to have an immediate impact though, because there are long lead times in these large infrastructure projects. And remember, the United States is playing catch up to many other countries in the world in terms of its infrastructure situation rather than leaping ahead. Obviously, it would like to do a little bit of a leapfrog here, but we'll see how that goes. And it will take several years to really fully manifest in any significant way. It's great that the decision's been made, but it will be a long lead time and the stock market response was muted. The tech sector actually ended the day very weak, and that could be the canary in the mine, if you like, that perhaps things don't look perfectly rosy quite the way they used to in terms of the bullish sentiment we've seen in stocks. I would suggest you on the day to again be respecting the upward price action overall, but keeping an eye out for a turnaround. If, however, my view of the world that perhaps stock markets will need to correct, or even forget that stock markets will even react to the on-the-ground fundamental realities, just the notion that there is going to be ongoing supply chain disruption, there is going to be a moderation in global growth. The trade that could most effectively benefit from that scenario is probably oil. So despite oil's occasional strong rallies, it is looking like a long-term top. I've told you that before. That's still the outlook. And of course, we have inflation data coming out in the US tonight. So I'm actually calling for a number around 5.8%. Imagine if it was a 6% number. That would cause stocks to tank quite dramatically. But I do think 5.7, 5.8%, it's above consensus, it's higher than what other people are saying. I do think that's a real possibility, and I'm absolutely convinced that inflation is going to stay higher for longer. In fact, Goldman Sachs have started to join our view in the last few days, suggesting that could be the case as well, but still not quite getting it the way we are. But it's nice to see that market mood, if you like, or herd shifting in the direction of ACY. The inflation number will not cause an immediate Fed response, but it will be further ingredients, if you like, in the cooking of the pot towards tapering and interest rate hikes in the US. As you know, I've been calling for some time now that tapering will begin within 1 to 3 months. Tapering will definitely begin this year. A lot of people have it late next year or something, definitely this year. And interest rate hikes will be occurring next year. They won't be massive interest rate hikes. The first one might only be 10 points just to test the waters, if you like. But they will go to 15 and 25 points over the coming years as everything around the world begins to normalize, as I've just said in the previous segment. But this event could really generate some volatility in the way that the infrastructure bill passing the Senate didn't quite manage to do. The risk is to the downside, but we are definitely possibly going to see, possibly, it's because it's all so hard at the moment. But I do think there is a real risk that on the announcement of another high inflation number, the market falls sharply, big fall, just gaps, no buyers for a little while, and then it comes roaring back as it has previously, testing where we are now, perhaps moving higher, and then after another few hours it starts to fall away again. We've seen that sort of price action before. That's a definite starter as a possibility for New York trading later today. So I would be keeping an eye on that. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities.